Ruchir Sharma. Welcome. Good morning, Ruchir. What are your
Hi.
expectations for the Fed tomorrow?
Well, I don't think the Fed's really going to cut tomorrow. And to be honest with you, I don't see the case for a rate cut. I think that's the more important point. The fact is that the real interest rate here, the real Fed funds rate, is just 0.5% currently. And if you just put that in the big picture, that's about as low as it has been in America's post-war history. So with a real Fed funds rate of 0.5%, do we really want lower rates at this time when the economy, yes, a lot of the sentiment surveys have weakened, but the overall economy is still growing close to what is the new trend of around 2%. So I don't see the case for a rate cut just now.
Steve, what's the case for a rate cut?
Well, I will tell you, Sarah, you've been a journalist for a long time like I have. You know the old rule that if you can think of a story today, you ought to do it today and not wait for tomorrow? If the Fed believes that it ought to eventually cut rates and cut rates in July, why wouldn't it do it today? But I do want to reflect what Ruchir is saying from our survey. I'll send it to you, Sarah, and we'll post it online. You can read the comments. This group of 46 economists, strategists, and fund managers, they have reversed their opinion of what they thought the Fed was going to do. They thought the next move was going to be a hike, but they have done so very reluctantly, following the market, following the headlines. They are a lot like Ruchir. They do not see the case. What they see is a slowdown in the economy. They see a Fed funds rate that is still stimulative as far as they're concerned. What did Ruchir quote? A 0.5% real rate, and they don't see the cut there, but they still think that's what the Fed's going to do.
Hey, Ruchir, I'm a little confused because your own firm, Mike Wilson, put out a list of hard data that is concerning and sort of reaffirms their they're more bearish than consensus view. Rail traffic, retailer earnings, ADP, NFP, PMIs, durable, distillate oil demand. I mean, the hard data is not missing entirely.
Yeah. Listen, I'm on the investing side. So, of course, there are very different views that, that we have here. But my own sort of feeling is this, that we are now in the 10th year of this economic expansion. And to me, it just sounds a bit sort of surprising that we keep wanting more and more stimulus. That's the really bigger point that I want to make here, which is that we have had a lot of stimulus in this cycle. And if in the 10th year we still want more stimulus, that's a real problem. And I think that what we're overlooking is the negative effect that these low real rates have had on productivity, on the economy. That's the op-ed I wrote this weekend for the New York Times, basically making the case there that just look at the productivity numbers, that they have fallen in line with lower interest rates, because we've seen a big increase in the number of zombie firms in this country. It's in fact 16% of all listed companies today are zombie companies compared to about 2% a couple of decades ago. We've seen much greater concentration of the big companies. That's been facilitated by low interest rates. So I don't think we have paid enough attention to what is the downside of having these low rates and constant stimulus, and focus far too much on just rolling out the stimulus at the slightest sign of trouble.
I'm interested in what constitutes a zombie company in terms of what financial metrics you're using there. I assume it's one that can stay in business because rates are so low, so it's not really actually going to be forced out of business. But give me a little bit more there.
Yeah, it's about the fact that if you look at the EBITDA in terms of how much it's earning, it's basically low, sort of just not enough to even make its interest payments. So that's really what it is. The Bank of International Settlements has defined this, that over 3 years, what exactly is a zombie company. And it's basically companies where the profitability is so low that it's just the interest payments that they're able to make good on.
By the way, guys, Bloomberg headline here that she has agreed to meet with the president. This is quoting Chinese state media.
Carl,
so we now have that from both sides.
More confirmation, session highs.
That's important for what you asked earlier, right? Which is the idea that the economy was going to slow was baked in, I want to say, late last year, maybe even earlier than that. Everybody expected that. It's the trade and the tariffs that turned a garden variety slowdown into something more worrisome. Now you have to ask yourself, put yourself in the shoes of a Fed policymaker. What do you do if that threat goes away? And you have, for example, a buoyant stock market, financial conditions will be easing in that context. And if the forecasters are right in our panel here about that 2.2% growth, and you have a forecast, you say the potential is 1.8, you're above potential growth. If that's going to be the forecast, it's very hard to make a case for easing in the case of that if it's just a garden variety slowdown.
I mean, but Steve, if the Fed really does pay very close attention to the markets, you have the bond market already pricing in a few cuts this year. You have the stock market 1% away from a record high, which you could argue is due partly to the fact that there's an expectation for a Fed cut. So what does the Fed do with that kind of market information?
I think it has to ease the market away from its very aggressive stance. Again, I go back to the commentary in the Fed Fund Survey where a lot of people think the market is well ahead of where the Fed is and well ahead of where the data are. And I think that's a really interesting way to think about it, that the Fed has some ability to control this. It's interesting. In several interviews I've done, they did not take the opportunity to talk the market down. We'll see how Powell handles this tomorrow.
Steve Liesman, Ruchir Sharma, thank you both very much.